Hello, welcome to Dissident Canada. My name is Tyler, and today, the oh so exciting topic of Canada's budget, because that's coming up in a couple of months. It was supposed to be in like a week or two, but then it got pushed back. It sounds very familiar of what happened with the fall economic statement last year. Wonder if that'll happen again. But I bring this up because there's a few news stories from the propagandists out there that is quite interesting to say the least. The news story that I think is the most interesting is straight from the state media known as CBC. Headline: Canada should be ready for generational investment. The Minister of Finance says ahead of budget. Like, we're over a month out still from the proposed issuance of the budget, where we're going to see the line items of how expensive and how big the deficit is going to be. And yet they're already out there stating generational investment and comparing it to what happened in 45, which is absurd. Absolutely absurd. Just the, like, estimates are it's going to come in somewhere around, say, $60 billion deficit. All right. I would assume it will be bigger than that, because even Mark Carney says it will be bigger than last year, and last year was what was it, roughly a $40 billion budget or something like that, deficit, 40, 45, something like that, maybe 48. And if they're predicting, like, they're out there saying, hey, last year was estimated to be 60, and we're already saying, hey, it's going to be generational investment. The budgets to come are going to be larger and larger. This is like 1945. This is the moment where Canada needs to reinvent itself. Those are the quotes that are out there. And, like, we need to make generational investments in order to be less dependent, more resilient, and bring prosperity across our nation. That is technically not wrong, okay? The problem is I don't trust these people with these supposed investments, and we really shouldn't be looking at them as investment when the government does it. And if you want more proof that I actually do believe the government has to pay a price to roll back some of its policies, there's a whole bunch of videos I've done being like, okay, if Canada wants to move forward, you're gonna have to, do a deal with the devil, pick some winners here, and show that, yes, Canada is a good place for business, and we are not going to do what we have done to multiple pipelines, which is at the last minute yank it. That is, needs to be very much put out there. But the budget is going to be an issue. And if they're already saying, again, that it's going to be massive, the federal debt of Canada from just the feds, all right? This is the federal debt, sits at the end of last year, all right, is $953.9 billion. So we can expect that to hit over 100 trillion real easy. Like, we'll probably at least have a budget deficit of 50 billion, because we added 6 billion of unexpected debt when Mark Carney came into office, before he won the election, when he won the leadership race, when he sold a whole bunch, it's like 6.2 something billion dollars of U.S. denominated debt bond, or U.S. denominated bonds, that have to be paid out. Like, there's probably 2 monthly coupon payments, or yeah, two coupon payments, which will be 2 months. That'll happen in it. So, and if I'm remembering correctly, the yield was like 6.5. So 6.5 divided by uh, you could do 1/12 for one and then times two. But like, it's an absurd amount of money. Okay, so yeah, easily we'll have 1 trillion in debt, because not those coupon payments that I talk about, that's paid out in dollars. Like, this is dollar denominated debt. So there's a almost 40% increase in the debt because the Canadian government has to go buy dollars to then pay out this coupon. So that's roughly what the exchange rate is, plus whoever's changing hands is going to take their percentage. So say roughly 40%. So just off the top, those coupon payments are 40% more expensive than if they were Canadian. And the fact that this is basically was an emergency budgetary decision, that is money that was not accounted for and cannot be accounted for with all the taxes, plus all the suspensions of taxes that have, temporarily happened and then been reinstated. I mean, you could see the tariffs possibly counterbalance, and you don't see like an 80 or $100 billion deficit. I don't think so. But honestly, we'll have to see. But yeah, you're looking at very easily $1 trillion that the Feds. Plus, if you add up all the municipal and provincial debt, we're probably at another hundred, or no, another trillion, or close enough, in all likelihood. So that would put us, at about a near 100% debt to GDP. Definitely, we'll be at 100% debt to GDP if you discount all government spending, which is roughly half of the Canadian economy at this point of GDP numbers. So yeah, that is 100% debt to GDP. In reality, it'll be over that. But the question is, in the next few years, as we see the economy, continue to turn over into recession economics, if not outright into depression economics, and again, globally synchronized, we have to think about, will we have a sovereign debt crisis with the bonds? And it's a very good question, because like $1 trillion in bonds. Now, most likely all of that isn't going to roll over, so I would suspect that the rollover rate would be anywhere between 50 and say 70% of what's got to roll over of the federal debt. And you consider what's already happening in the European bond market, where Germany, France are having issues. Their bond markets, they had a spike a little while ago, and it's not great. There's questions if the UK and France have to have an IFM bailout, or IMF. I didn't say that right. So there's likely another sovereign debt crisis brewing in Europe, and my assumption is that Canada will likely have that in the same timeline as them, so in a couple years, because you have to have the economy completely roll over into, say, depression/recession economics. You then have to have the federal government come in and do all the bailouts and stimulus packages. And then you wait a couple years for that debt to roll over from, say, the front end of the curve into the long end of the curve, where you'll see yields start to spike. And the question is, will that happen with Canada? And the reason I bring that up is, will it happen with Canada, isn't so much that our bond market is small or large. It's because of the trade war with the United States. Because the trade war with the United States makes it so that it's unattractive for Canadian businesses to do business with Americans, which is strangling Canada of dollars and dollar assets, which banks need to operate. So if they're short on dollars and, say, dollar collateral items, when you go into a recession or a depression, banks buy what is considered safe and liquid. So government bonds, as I have said for a very long time now, are safe and fairly liquid. They are dollars plus. They are currency plus, because you're earning a reasonable percentage. And you have to figure that, like, the way banks operate is the cost of their money, or their currency that they acquire, is relatively low. Like, if you look at, say, your savings account or your checkings account, you're not making 5%. You might be getting a couple percent, depending on where you are. So, if government bonds are anywhere between, 2 to 3%, you're making easy money, and you can adjust the interest rates you play. Like, obviously, I know they're much below 1% at this point, I believe. I haven't taken a survey of all the banks, because I am not moving banks anytime soon, because they all suck. And I don't want to be any more frustrated, like hop to a new bank and be like, oh, this is the same BS they were pulling at my old bank. I may move to a credit union at some point, but we'll see. Because at least they try to treat you right. But anyways, so if you get $100 million as a bank, all right, and you only have to pay half a percentage point, all right, and you're risk averse, you don't want to lend into the real economy, you can't really lend any more into, say, the financialized economy, because even that looks risky, and you don't want to take that money and gamble it yourself in the financialized economy. You definitely don't want to give it to hedge funds, because that looks like a powder keg. Commercial real estate looks really, really bad. So where do you put your money? Well, you put it in bonds, because it's easy. You just sit there, and you're paying 0.5% for new acquisitions of money, and you're getting, at this point, what is it? I have to do that. Switch over from US to Canadian yield curve. You're getting anywhere from, oh wow, that's a pretty big delta. So the bond curve at the 1 month starts as of, when was this? Yeah, the 22nd of September 2025 was 2.46%. So, and then it tops out at 3.66-ish. Okay? So that's anywhere from, you're getting a almost 2% to almost 3%, or slightly over 3% if you want to go long. I don't suggest going long, other than you need to. So you're getting like a free 2% for just sitting in bonds. And as banks acquire more and more, commercial deposit liabilities, which is deposits, they have to park their money somewhere to earn interest. So, like, these banks have, like, if you just look at, like, the top, what is it, 6? There's, like, 6 big banks in Canada. They need to park their trillions somewhere. The Canadian, again, the entire bond market is going to be, by, like, the end of this year, roughly $1 trillion. And pensions also have to buy bonds. So, like, you may get a sovereign debt crisis at the long end of the curve where it is extremely illiquid. Um, that that's the law. We're talking like 20, 30 year bonds at that point. Like that's the long end of the curve. Um, so even mechanically, with the fact that if we go through a liquidity crisis, which means there's not enough currency flowing, banks need to sell stuff. Like right now, you're going through the buying phase of stocking up on safe liquid so that if you run into liquidity problems, you can sell that and you lose very little. Because the way bonds work is the percentage you lose if there's a fire sale is much less than any other type of asset. Like you may lose at a most like 5 to 10%, versus if you say do gold. Uh, if you look at the fire sale that happened in like 2000, was it? There was a sale in I think 2008, but like when gold goes through like a sale, you can have like a 40% pullback. Not exactly safe, and you can say the same thing with stocks and other bonds as well. So, like government bonds, relatively safe from a bank's perspective. And because the market is so small, the Canadian bond market, and banks by law need to own a certain percentage of bonds, you can get into a situation where the the Canadian banks are loaning to each other, which is going to create a very nasty web, and rehypothecating outside of Canada, because I don't think rehypothecation inside of Canada is illegal, but they'll rehypothecate these bonds in jurisdictions where they can do that, say the Cayman Islands or other such less restrictive banking regulations exist, and you're then able to turn $1 trillion of collateral into, say, $20 trillion of collateral if need be. And then you have $20 trillion of collateral at, say, at max, which means you then can have $20 trillion worth of loans backed by that collateral, and you get the liquidity you need if you need to do that. And it will drive demand for bonds, so you may not see a massive, massive spike at the shorter end of the curve. So think like, say, 3 year and shorter. Now, this is all theoretical. I still think there's a good chance that there is a sovereign debt crisis, but I am laying out the groundwork for why there might not be, because Canada is in an interesting situation if we compare it to previous downturns in the Eurodollar system, because Canada is restricted with the amount of dollars flowing across the border. Like, that's really the isolating factor for why 2008, and like while the economy was trading sideways for like 20 years, it hasn't been 20 years yet, it's almost 20 years, but why the economy has been trading sideways and slightly down in real terms is because we've had that relationship with the United States where we have in fact taken advantage of them. It has been beneficial. Like we kept the flow of dollars, which is what you need to have a functioning economy in the global financial system. You need a good flow of dollars. Canada has had that. So it'll be very interesting to see what happens when you remove that, or restrict that in a financial system. Like we already know what happens with China, Brazil, and the rest of the world. It's not good. So, like, you could very much have a system, again, in which you have a sovereign debt crisis or, you know, some form of debt problem. Like, they'll probably name it a sovereign debt crisis. It's not like bonds aren't going to be sold or bought, I should say. Like, it's not like you're going to go to a Canadian bond auction and, the big banks didn't show up and didn't buy the bonds. What a sovereign debt crisis is that yields spike more than what is thought. Like think, a full point or two or three above um, the what the going rate is, or what, let's say, the Bank of Canada's overnight interest rate is. So if we get to zero and the 3 month is at 3%, and say the 30 year is at 6%, that is a very good indication of, say, a sovereign debt crisis. Like you get a spike out of nowhere, and it's bad. Like the big problem is, like, the Canadian bond market is so small. It's half the size of the US T-bill market, which is insane because their bond market is ridiculously big in comparison. Like, you're talking more that you're almost, this year it'll be like 40 times larger. Like, if the United States at the end of the year hits $40 trillion in debt, and we only hit $1 trillion in federal debt, that is a 40 times larger bond market. Okay, that is a lot of debt. But the U.S. has ways of dealing with that systematically, or nobody talks about, but a few people. But let me just see valuation. What does that do? Interesting. Yeah. So we'll see if we can get a sovereign debt crisis. Like, the more I think about it, I him and I haw, and I dither back and forth, being like, well, the bond market is larger than it was in 2009, so there's a greater debt to carry. But the Canadian banks that need the bonds, I mean, they also need other bonds, but they need Canadian bonds to meet regulatory requirements by percentage, are also, like, their balance sheets are larger too, so they can absorb more and will absorb more. Pensions are going to buy more because it'll be safe liquid assets, so they'll buy. Like, the question is how much, and at what percentage do they make? Like, the lower the rates are, like bond rates, the higher likelihood that banks lend into the real economy, and the higher rates go, the less likely they become, because they're just pocketing free money. Like, if interest rates went to 15% overnight, banks would pour in and just pocket the free money like there's no tomorrow. So, and then, like, the economy would come screeching to a halt. They would pour in, more and more people would buy, bring rates down, and then they're not getting their so-called free money as easily, so the lending into the real economy looks more interesting. Like, that's the cycle we go through nowadays, is dealing with that. So, but, like, this budget is going to be nuts. No matter what happens, the Canadian budget is just going to be weird. Looking at the line items is just going to be crazy. It'll be like, hey, well, for me specifically, because I live in the Waterloo region area, and there'll be 3 schools that are going to get, I don't know if they'll get 3 billion total, but they'll get, like, between the 3 of them, they'll get clear $1 billion easily. Like, the University of Waterloo is going to get all their money. Wilfrid Laurier and Conestoga College are also going to get shit tons of money. Like, let's be real. And I'll look at it and I'll be like, how are these not government entities at this point? But, the entirety of post-secondary education is also going to get a whole bunch. You'll have NGOs getting a whole bunch. Now, like, Carney said he wants to cut back the federal government, and it's an ever-increasing number that seems like it's doable. Just go back to this stupid CBC article. Like, it's the first year will be, 7.5%, then 10%, then 15%, like, cuts on operational spending of the feds. That would be great. You could do that you could get 15% in 1 year by just cutting off, post-secondary education and NGOs easily. Like, if Carney cuts government operational spending, all right, he will be a better prime minister than the vast majority of conservatives. And if he can do it the way he says he wants to, I will give him praise. He's still a globalist piece of shit, but cutting the budget is necessary evil. It will be necessary to deal with his evil if that happens. I don't think it will, but hey, we'll leave it out there because we're talking budget nonsense. Well, when I get my hands on the budget, I'll probably do a quick read through of it. Probably make a video about how insane it is, and so on and so forth. Until then, have a good day. I will see you tomorrow with something. It's how it goes these days. Just last minute topics that I can talk about because I can. Until then.